Hello, favorite realtors. Hello, favorite past clients. Hello, current clients. This is Chad Lubin, and this is your 2023 rate and housing forecast. So I get this from a mentor and analyst that I followed for 20 years at MBS Highway and Barry Habib. I've been following Barry for 20 years. I have a finance degree. I've been following these markets every day of my career for 20 years. So that's where this level of insight, analysis, and forecast come from. So we're looking at several factors that's going to drive our market in 2023. First and foremost is inflation drives mortgage rates. So if you look at this line being inflation, this line being mortgage rates, and this bottom line being inflation, you'll see that mortgage rates are driven by inflation. So right here is inflation, 2%, 2%, 2%, 2%, around 2%. Fed did a very good job through really 2016 to 2020 at keeping inflation very, very low. Then COVID happened, right? And we had what's called quantitative easing. That's when the Federal Reserve buys mortgage bonds and keeps mortgage rates artificially low. And as you can see, inflation started spiking around March 2021, and definitely by July. You see this start to really take off. And why did interest rates not follow that? Well, because the Federal Reserve Board was keeping these mortgage rates at 3%. And as you can see, hindsight's 2020, but they let it go too long. So we really started to see inflation take off almost all of last year, 2022. Now, what has started to happen? You're starting to see it come down, and mortgage rates will follow. And we believe this trend will continue through the first half of 2023. And when you look at what supports that statement, how inflation works is the main really index that reports this inflation is what's called the Consumer Price Index report. So 2022 landed right at 6%. Now, this is the core CPI, which strips out food and energy, which are obviously big costs, but really can't be impacted by monetary policy. The other things can. And what's happening and why you're starting to see that inflation come down is we're replacing the large readings from the beginning of 2021. So as you can see, July, August, September 2021, inflation was fairly contained. These are monthly increases. And then we started to see the big spike around October. And now you can see October 2022 replaces this October number, right? So it was half of what it was 2021. So that replaces that number and it brings the yearly average down. We saw the same in November. So if you see these readings from 2021, you'll know that this year's readings are going to replace those. So everything besides March of 2022 was a high reading, which should get replaced by a lower reading as inflation has come down. Now, remember, and if you've watched my weekly market updates, you'll know I've been talking about this quite a bit, that shelter costs are lagging indicators. So rents usually last a year, right? Sometimes it takes the economy to slow down before hotels, rent, home prices come down, and you're starting to see this come down in real time. So right now we're at about 4.6% shelter costs. Now, keep in mind that the yearly average is used for these things. So real time, we're down 4.6, but this real time is just 1 month. Right. So we're going to need to see this continue to bring the yearly number down is what the Fed and really the markets work off of. So it's a lagging indicator. So we're seeing shelter costs come down in real time, but it's not going to come through on the reports really until February or March. So think of it like a roller coaster. This is shelter and CPI right now. These are the readings that are coming out real time, January 2023. we already know that they're coming down, but we got to wait for the whole roller coaster to get down the hill before you see that yearly average come down and the Feds start to think that inflation is contained. They are trying to get inflation around 3%. Or the CPI number, excuse me, around 3%. So we're about halfway there. So we believe, if you look at the chart, that really the shelter costs will come down across the board. And you've already seen this with food, with gas, with closing. These costs have already all come down. But the shelter cost is that lagging indicator. It is slowing down. We believe about March, which will show February's readings, that all of this will come through and really pull the CPI number down. So lower interest rates, March to April, which will line up well with our spring buying season. So our expectations are to have a great spring and with some refinance activity. So we'll show you another reason why we're predicting that. This is the spread between the 10-year treasury, and I won't get too complicated here, but there's really two bonds that are sold on the secondary market. There is the mortgage-backed security, the 30-year fixed, and then there's a 10-year treasury, which is a bond sold and issued by our government to pay for our debt, which obviously we have a lot of right now. So there's always a spread. The normal spread's about 1 3/4 to 200 basis points, or 1.75% to 2%. There's that spread. But end of 2022 into 2023, we saw this spread going as large as 300 basis points. And really that is because servicing on a mortgage-backed security has been worth next to nothing. And if you think about this intelligently, everyone thinks they do their mortgage and it stays with that mortgage provider and they just hold that money. That's not true. They sell it on a secondary market. It looks that way because they keep the servicing. There has to be someone responsible to answer questions. There has to be someone responsible to make sure payments got made. There has to be someone responsible to answer questions and to make sure that the taxes and insurance are getting paid. That's what I was trying to think of. But if you think about that, that servicing is worth nothing. The mortgage lenders can also sell the servicing. But when you have a 7% interest rate, so the treasury was hitting about 4%, mortgage rates were above 7% at that time, the servicing is worth nothing because they know that these clients, when rates come down, and everyone in the mortgage world probably thinks near what we do, that these rates are coming down and inflation is contained, they're not going to sell that servicing for anything because the mortgage world knows that people are just going to refinance and it's a bad investment. I hope that makes sense. So you'll see this spread start to shrink and normalize, which will help mortgage rates come down. So if we see the 10-year treasury getting to 3%, that means we're feeling interest rates sometime the first half of this year to normalize around 5%. Remember, Fannie Mae predicted last year that rates at some point in 2023 would return to 4.5%, which is close to 2% less than they are right now. So we see a big refinance rally coming this year. That's why we're very much beating the drum to get in the home now, because there's still a lack of inventory, which I'll show you in a second. So this is another reason why we feel we'll have a strong housing market and a strong year when it comes to mortgages. So yeah, see that spread is already narrowing. So the spread was 300. It's already narrowing down to about 270 basis points. So it's come down 30 basis points already. So we believe that trend will continue throughout the first half of 2023. Let's see what we got next. Recession. Yes. Recession is coming. I believe we're already in it. If you've been listening to me last year, I've been saying since February that we're in a recession. It's just people haven't realized it because savings were at all-time highs in the beginning of 2021. So we had more money as a country in savings than we've had since really pre-COVID levels, right? So if you look here, This is stimulus, right? Of course, people had more money because the government was stimulating them with PPP and with some of the other payments that came out to individuals. You'll see savings. This was stimulus here. So I think it was stimulus here, and stimulus here was about where it worked out. And of course, that came into our max savings, but that has dwindled away, right? And people have continued their lifestyles, but spent their savings, as you can see, and started putting it on credit card debt. That is a leading indicator of a recession. Now, what's the good news of a recession? That mortgage rates are always lower in a recession. Always, always, always. I'll show you proof of that in a second. So we believe we're in a recession. That people will start to realize that they're compiling debt. I see a lot of cash out refinances being done at lower mortgage rates. Credit card interest rates are around 22.5% right now. When you can refinance that into a cash out 6% mortgage, you'll see people use their equity to pay off this debt that they've put together. So keep that in mind as well. Now, inverted yield curves are another leading indicator of a recession. So yes, I believe we're in a recession and have been, and you'll start the problem with the government and I forget the service that calls a recession. They do it like a year after it's over, right? So it just doesn't, there's no way. These are the indicators you need to look at. By the time they say it, it's almost already done with. And I believe we'll pull out of it quickly. I believe the Fed, although they were way behind the 8 ball and waited way too long and left the economy running, and I don't believe in the stimulus that were provided after the initial. I won't get political on this, but there was just too much money pumped into our economy too quickly and for too long. And when you see these recession indicators, you can tell that we're already in it, right? So the good news of that, my word for this year is hope. Having only positive expectations. That's my word for the year. And there's hope in a recession. We always come out of it. And if you can get things at those prices, stocks, homes, interest rates lower, you're going to win. So if you look back, all these recession indicators on an inversion on the yield curve. Now, what is an inversion on the yield curve? It's when the 3-month treasury bond is worth more than a 10-year treasury bond, right? That's counterintuitive. The longer bond should be worth more. They're not right now. So recession, late 80s, early 90s, recession, .com bust right here, recession, financial crisis, recession, COVID, really, really negative now. So as you can see, almost as bad as the .com, probably right even with that, right? Worse than the financial crisis. Now, I'm not saying that the recession is going to be worse than the financial crisis. I'm saying this inversion on the yield curve, which has been going on all year, is screaming we're in a recession, right? So, what about housing demand and household formations? Now, it's usually, as you can see, in 2022, it hit as high as 2 million. So that's 2 million household formations, right? Meaning that there's 2 million households created. What's going on with supply, right? Well, builders have learned their lesson from 06 to 09 by the overbuilding, and they've started to slow down. And we're not at 1.7, we're about at 1.5 million housing starts completed. Now, don't listen to the media on this because they have it all wrong. They look at housing starts as the number of inventory. It's not. The house has to be finished and completed. So we only look at houses completed and what's on the market across the country. Now, about 100,000 homes need to be replaced annually because they're dated or they're not livable, they're not habitable, right? So there's about 1.4 million in new supply. There's 1.3 million in housing formations right now. Cool. So there is a large inventory of about 100,000 extra homes based on now. But what happens with interest rates impacting it? More demand will be created as homes or as interest rates come down on mortgages, right? So home price moderation. This is hardly a crash. This is something else the media is just spinning out of control. So we are up 115% on housing the last 10 years. I've been investing in the stock market well over 10 years, and I have not had 115% in all my stocks. So obviously real estate is an amazing investment. This is a slide you got to show all your clients. In the last 2 years, we're up 39%. So to only be down 2.5% with interest rates reaching 7.5% for some people, I just think that's an amazing stat from 2022, that we only have gone 2.5% backwards when we've ran up 39% in 2 years. That's incredible. So what people need to look at, though, is affordability. Now, this, stay with me here, this is a great indicator long term. So when you look at 2021, let's call a loan amount, the average loan amount was about $400,000. That interest rate was 3.5%. There's your monthly payment, right? Now, this year, home prices went up by 10%. This is 2021 into 2022. So we're looking at about $440. Now, that interest rate right now is about 6.25. Now, sometimes clients come back to me and say, I heard you said you had 6.25. That's not my rate. Keep in mind, down payment impacts that. Credit scores impact this. Type of property impacts this. So yes, year over year, we're up $913 per month. That's huge when it comes to affordability. Now, the average household income is about $9,000 across our country. That's household, that's not per person, right? So this is ADP. So stayers at their job are up about 7.6%. Switchers, believe it or not, when you switch jobs, a lot of times you'll get paid more. That's 15.1%. So the average income in 2022 was up 9%. So when you factor this in, their income's up about $810, right? So what does this all mean? That's good, and that should absorb most of this. But keep in mind, everything else is more expensive, right? So we're running at over a $340 deficit in affordability. That's a car payment for some people, right? So keep in mind that this will come down. And we also are seeing forecasts of another 5% in increases in wages, right? So that's $10,300 next year, right? So when we refinance these people that bought this last year and buying it the first part of this year to 5%, and they get this, this increase in their pay, right? Then we're up $1,300 in pay, and they're at $807. And keep in mind, those other prices are starting to fall down. So people's wages should outpace what these costs are as inflation comes down, which is an awesome indicator and gives me a lot of optimism. So what are we forecasting? Lower inflation, recession-like slowdown in spending, which leads to lower rates, which is super important to the housing market. Incomes continuing to increase, very tight inventory, which is going to keep prices holding firm. My realtors watching, you see this out in the market, and rents still going up and expensive and rising, right? Because their costs have risen. Keep in mind with rent, some people are locked in on 1-year leases. Those are going to be coming due, and most good landlords are going to increase the rent because everything's more expensive. So we are expecting low to single digit appreciation for most of the US, with a pickup in activity here around March or April due to some mortgage rates coming down. What are our headwinds? What are our challenges? Global quantitative tightening. Globally, things are struggling. Lack of foreign central bank buying, meaning there's no quantitative easing going down to artificially keep mortgage rates and other rates low. And they just keep pumping out money. So there's more debt to be financed. And at some point, they got to push up those yields to attract investors, because it's a little scary what our finances are as a country. So those are our challenges, our tailwinds, things that are going to help us. Definitely lower inflation. You've already seen it start to happen. Excess retail inventory. So remember, there's about 100,000 homes that should be surplus. So we should start to see a little bit more inventory tight or open up, which is good for those new buyers, and increase in mortgage servicing value, which is super important to bring together that spread between the 10-year and the mortgage-backed security, and a recession likely. I know people hate a recession, but we've already been in it for a year. I hate that they won't say it. We're in a recession, right? My stocks are down like 30% this year, right? We are in a recession. Cryptos have crumbled. Bonds have had their worst year since the Depression. We're in a recession, and I believe we've been in it since the second quarter of 2022. So the good news on that is rates come down, policies get accommodating, and we'll start to see some help. And remember, it's an election year coming up. They want the economy to look good. So we are expecting a 30-year fixed mortgage rate of around about 5% for the first half of this year. And we're expecting the 10-year to be at about 3%. So a lot of optimism out there. Work hard, get in front of your buyers right now. Tell them this is a great time to be buying. And gosh, if I can help you in any way, I'd love to talk to you about this further. Thanks for watching my 2023 market update and outlook.